Hello, AP Macro students. It's me, Mr. Snabria, and today we are going to begin to learn about monetary policy. So before we do that, I did want to take a moment to kind of go through kind of a rough sketch of what we're doing in terms of countercyclical policies so that you understand where monetary policy fits into all of that. So let's get over to that real quick. All right, so here we are, and we're going to be just talking about countercyclical policy, and we're going to start a little bit of a flow chart that ultimately will go into your notes. But for now, I just want you to kind of follow along as I go through this. So we have countercyclical policies up here at the top, and that's kind of an umbrella term for any kind of policy that we are going to do in order to try to manipulate aggregate demand and counter the business cycle. So broadly speaking, we have two different types. One is fiscal policy, which you already learned, and the other, which we're talking about today, is monetary policy. So fiscal and monetary policies are both countercyclical policies, which means they're both demand-side policies. These are policies that are going to shift aggregate demand. And for each of these, they can be either expansionary or contractionary. Okay. So they can be expansionary or contractionary, meaning you're going to increase aggregate demand with your expansionary policies. You're going to decrease aggregate demand with your contractionary policies. So we already know that with fiscal policy, what you're doing is you're changing taxing and spending. So for an expansionary policy that's a fiscal policy, you're going to increase government spending and you're going to decrease taxes, and vice versa for your contractionary policy. But what we're going to do today is we're going to learn what the tools are for an expansionary monetary policy versus a contractionary monetary policy. So this is pretty much our framework. The key here is that any sort of countercyclical policy is a demand-side policy, and it's either fiscal policy or monetary policy. And the real key between these two, in terms of what makes them different, is who's doing it. Congress does fiscal policy, and the Federal Reserve Bank does monetary policy. So we'll kind of leave it here for now. We will finish this chart up later, and at some point I'll want you to put that into your notes, but for now let's just go ahead and learn about monetary policy. All right, so now that you understand where monetary policy fits into this overall scheme of economic policy that we are going to call countercyclical policies, let's just go ahead and get into how exactly it is that the Fed, which we'll learn about who exactly the Fed is able to manipulate aggregate demand by manipulating the money supply itself. It sounds very complicated. It's actually relatively straightforward once we understand some basic principles of banking. So let's just go ahead and dive right into this thing by first defining monetary policy. So monetary policy, as you can see here, is central bank efforts to promote full employment, maintain price stability, and encourage long-run economic growth, right? Those are our three measures of the economy, and that's how we want to see them through control of the money supply. And I say and interest rates, however, what we'll find to be true is that the way they control the money supply is through manipulating interest rates. So it might be more accurate to say through control of the money supply by way of interest rates. However, that's a small detail there that's not really important to get hung up on right now. Trust me, we'll fully understand this by the end of it. Now, First note on the definition here is I don't say Fed efforts. I didn't say Federal Reserve Bank. And the reason I don't say that, I instead, if you follow the cursor here, I say central bank efforts. And the reason is because there is a central bank for every major economy in the world. So this is not a United States-centric policy initiative. This is something that every economy that you might encounter or study is going to do. There is a central bank, and actually if we kind of look down to the next set of bullets, you'll see at the very bottom of the slide, I give examples of other central banks throughout the world, the Bank of Japan, the European Central Bank, and the Bank of England, just to name a few of the various central banks around the world. Now, with that being said, here in the United States, the central bank is known as the Fed, which stands for, or is the shortened term for, Federal Reserve Bank. Now, what I don't want you to think is that this is the same as the Feds, which is often how the FBI is referred to. The Fed is actually not part of the government, and we've talked a little about this before in class when we were talking about money last time. Because I mentioned last time that the Fed is the sole supplier of U.S. currency in the United States economy. Well, they are not the government, but they certainly are of the government. And the people who are in charge of the Fed must be confirmed by Congress. They're appointed by the President of the United States. And I'm speaking specifically about the chairperson of the Fed. But beyond that, they're limited in what they can do policy-wise to a certain extent, by getting permission from Congress. However, what we're going to find is that the main thing they do in terms of monetary policy, which is the manipulation of interest rates, they have an extremely large amount of room to work autonomously without seeking permission from the government to do any of that. So my whole point in all of this is they are quite well insulated from the political environment. So perhaps some of the negative aspects of fiscal policy, which came from the fact that it was the government that had to do it, we're not going to see those same political hang-ups with monetary policy, because the Fed is able to operate with a certain level of autonomy from the government, meaning less influence from the politics of the day. And also, frankly, most citizens don't understand Fed policy and what the implications are and how it works, so there's not really ever a big backlash from the voting public over what's going on with the Fed, because hardly anyone understands it. Fortunately for you, you are going to be one of those people who do understand what's going on with the Fed. So that's exciting. So let's go ahead and move on, because what we really want to do is not talk about the Fed today. We really want to talk about types of monetary policy. But I guess just one last thing concerning the Fed before we get into really the monetary policy aspect of today is just kind of a note on testing and the fact that you're going to take the AP exam or any other assessment of your knowledge about countercyclical policies in general. If anyone suggests that the Fed or the Federal Reserve Bank or the central bank does something, that's got to be monetary policy and not fiscal policy, right? Because monetary policy is the policy done by the Fed. So likewise, if someone suggests that Congress does something, you know automatically that we're talking about fiscal policy. So that's one of those big divides. The initial branches of the graph that are more kind of flow chart that we went over at the beginning of this, it's a huge indicator of what we're talking about, fiscal versus monetary policy. Who's doing it? Now, just like with fiscal policy, there is the expansionary and contractionary version of monetary policy. So we have our little nicknames that have been given to both of these. Expansionary is called easy money. You'll often hear that, an easy money or an easy policy. by the Fed. And this is, as you might expect, a method or a policy aimed at increasing aggregate demand during a recession. Okay, you want to bring the economy back to full employment, right? You want to reach that long-run macroeconomic equilibrium. You want aggregate demand to shift right, closing a recessionary gap. You're going to do expansionary monetary policy. All right, and expansionary monetary policy it involves increasing the money supply. So this is all pretty intuitive, right? You're in a recession, put more money, more aggregate demand. Okay? Contractionary policy is going to be the opposite of that, and it's known as tight money or a tight policy. Okay? It's used during inflation to return the economy back down to full employment, so you're going to decrease the money supply. So you're going to decrease the money supply, shift aggregate demand to the left, get us back to natural rate of unemployment. So pretty intuitive, I think, in so much as we understand that the business cycle is aggregate demand shifting back and forth, and that expansionary policies in general, whether they be fiscal or monetary policies, are aimed at manipulating aggregate demand back to center, back to long-run macroeconomic equilibrium. And luckily for us, expansionary is more money, contractionary is less money. That's a relationship that's pretty easy to wrap your head around, and just go ahead and internalize that. So the complex part of Fed policy or monetary policy is how they accomplish that. And there are 4 tools of the Fed, all right? 4 things. You've got to know them. You just have to know them. And they kind of build off of each other, and they interact with each other in a lot of ways. You've got to understand this entire suite of tools, or you will not understand monetary policy. And I say that, but I'm really focused on the first 3 here. TAF, Term Auction Facility, is a new tool of the Fed that was actually invented during the financial crisis in 2007. So really, when I say you are not going to understand the way that the Federal Reserve manipulates the money supply if you don't understand these, I mean if you don't understand 1, 2, and 3. You must understand all 3 to understand how it is exactly that the Fed can control the money supply. It is not, unfortunately, as simple as they just flood the economy with money, or they go around scooping up all the money and putting it in a vault. Like, that is not how it works. It's significantly more complex than that. It is all about banking. In fact, today's class and the next several classes that we'll take, this is basically, we're going to do a banking class. This is the work of bankers. And so we're going to see the role that financial institutions play in our economy. And it is, in fact, a quite significant role. So, the first of these from our list is the required reserve ratio. So I have it defined up at the top as the percent of demand deposits that must be stored as vault cash or kept on reserve as Fed funds, you don't know what that is yet, in the bank's account with the Federal Reserve. Simply put, it's the amount of money that banks cannot loan out. Stop right here if you're writing notes. Don't keep writing. I want you to just listen to me talk about this first little paragraph. So imagine that you put your money into a bank, right? Have you ever thought about how the bank makes money? Well, I'm going to tell you real quick in case you haven't. What banking is that you put your money in the bank, and the bank holds that money for you. They keep it safe, so to speak, and they let you have access to it whenever you ask for it. But in the meantime, they loan that money out to other people, and they collect the interest payments, and that's their profit, right? So everybody pulls their money together. They put it all in the bank. The bank's sitting on all of this money. We already know that there's a time value of money, right? So if you're not doing anything with that money, it is, it's a wasted opportunity, so to speak. So the bank, not wanting to waste that opportunity sitting on all this money, is going to make loans with it. Or perhaps they're going to invest it. But we're not really going to worry about the investment banking side of things. We're going to worry about the actual lending side. of the financial business model. So they take all our money and they lend it out, but whenever we want to spend it, they need to make it available for us, right? So they have to be responsible about this. Well, if the bank lent out 100% of the money that I deposited in you and everybody else, then the second somebody wanted to make a purchase and take out some of their money, the bank wouldn't be able to give them their money, right? So there is a rule in place that the Fed is in charge of, which is to keep a certain amount of money on hand. They cannot loan out all of the money that they have. They have a required reserve, and it's in the form of a ratio, so it's a percentage of the money that is deposited into the bank. And when we say demand deposits, what we mean here is checking accounts and certain amount of money in savings. It's money, deposits that could be demanded at any moment, right? So typical percentage here is about 10%. If I put $100 in the bank can legally lend out $90. Okay, they've got to keep 10% in reserve. This is why banks' vaults don't have tons of money in them. Yes, it's a lot of money to you and I, but in the grand scheme of things, there's not a lot of money in the vault, and in fact, a lot of the money is actually in the form of electronic deposits, so the amount of cash that's actually in the vault is pretty low at any given moment. Now, moving on through this definition, we understand now, so there's a certain percentage of demand deposits that must be stored as vault cash or kept in the reserve as Fed funds bank account. What this suggests is that banks actually have an account with the Fed, and that's true. Okay, so you can't go to the Federal Reserve Bank in Dallas and say, I want to open a checking account. That's not how it works, but certainly Bank of America can and does and must actually. So the Bank of America has an account with the Fed, and the money that Bank of America keeps at the Fed is known as Fed funds, federal funds, okay? It's not the government's money, it's Bank of America's money, excuse me, that they keep deposited at the Fed. Okay, just kind of like the way you have a bank account and you keep some of your money deposited at Chase or Capital One. So, simply put, the amount of money that banks cannot loan out. Okay, so we're going to get into why that this is actually a policy, a countercyclical policy now. All right, so now thinking about how the required reserve ratio and the ability of the Fed to be the one to set what that percentage is, how is that a monetary policy? How is that going to lead somehow to increasing or decreasing the money supply, which in turn will increase or decrease aggregate demand? And that basically is pretty simple. Decreasing the reserve ratio increases the rate of money creation in the banking system. We'll learn about exactly how that is later. The purpose of today is to just create all of the relationships. In the future, when we do the fractional reserve banking, we're going to see behind the scenes why these things are true. Okay, so decreasing the reserve ratio increases the rate of money creation in the system and is expansionary and vice versa. So if you lower the required reserve ratio, you are increasing the supply of money, and this is a pretty easy relationship, at least on its surface, because if the required reserve ratio is 10%, meaning that if I deposit $100 into the bank, then the Fed can loan out $90 because they have to keep $10 as reserve, right? Well, if the Fed were to lower the ratio to 5%, if I deposited $100 in the bank, they could loan out $95. So you can see, at least initially, how there's more money out there in the economy just by lowering the required reserve ratio. So in terms of the monetary policy aspect of this, lowering the required reserve ratio is an expansionary monetary policy. Raising the required reserve ratio is a contractionary monetary policy. This is, by the way, the least used tool of the Fed, and is usually held constant at around 10%. Now, don't be fooled by me saying this is the least used tool of the Fed into thinking that this is not important. It's actually this requirement that fuels the rest of monetary policy. So even though they don't change it from 10%, really hardly ever, the fact that it's there is what's important. And by the way, I guess I should address the question. What happens if a bank doesn't have its 10%? Well, the banks will never fail to meet their required reserve ratio, or they are going to be subject to just a ridiculous amount of oversight, scrutiny, and possibly even closure of the bank. So this is the golden rule of banking, is that you have to have your required reserves at the end of every banking day. Okay, and it's that fact, the fact that that is the rule. That is the one thing you will not fail to meet that. Everything else about banking and monetary policy is designed around banks needing to meet their required reserve every day. So this is a really important rule, but using it as the policy in terms of raising and lowering it is the least used thing. There's other things that the Fed can do to manipulate the money supply without raising or lowering the required reserve ratio, basically by manipulating how easy it is for banks to meet the required reserve ratio every single day. All right, so it's compliance with this rule that is what's important. But if the Fed wanted to, they could do an expansionary policy by lowering the required reserve ratio. So let's look at our next tool of the Fed, which is the discount rate. So the discount rate is the interest percentage that banks pay the Fed for overnight loans in order to meet the required reserve. Okay? So if you are a bank and at the end of the day you don't actually have the 10% that you're supposed to have, well then you just borrow the money, all right? And you could borrow it from the Fed and you would pay some amount of interest on that, right? So the fact that you are a bank and you have to meet your required reserves means that if you can't meet it, you are going to have to pay a little bit to make sure you have the money there. And that's in the form of borrowing money from the Fed. Okay? So if you borrow money from the Fed to meet your required reserves, it's not for free. There is a percentage of interest, and that interest rate is known as the discount rate. It has nothing to do with getting a discount. So if you are a bank and you don't have your required reserves at the end of the day, one of your options is to borrow money from the Fed, and they're going to charge you a percentage rate of interest, and that is known as the discount rate. So how is this a monetary policy? Well, decreasing the discount rate lowers the cost of borrowing for banks, thus creating an incentive for banks to loan more of their excess reserves and borrow from the Fed in order to meet their reserve requirement. Okay, so basically, if it's really cheap for banks to borrow money to meet their required reserve at the end of the day, they might make more loans. And in making more loans, they're putting more money out into the economy. But if banks feel like it's going to be expensive to borrow money at the end of the day if they don't have their required reserves, they're going to be a lot more conservative about making loans that day, and they're going to ensure that at the end of the day they won't have to borrow any money because that might be expensive. So how is this a monetary policy? Well, lowering the discount rate is an expansionary policy, and raising the discount rate is a contractionary policy. Okay, so right now, this first day of monetary policy, I am content with you just memorizing that. Okay, and if everything I just said about, motivating banks to make more loans or discouraging them from making loans, if that didn't quite make sense yet, I'm okay with that. But what I need you to know right now is that raising the discount rate is contractionary, and lowering the discount rate is expansionary. Okay? Very bottom here, this is the secondary tool of the Fed. So this is not the primary tool. So changing the required reserve ratio was the least used. Changing the discount rate is the second most used. So what is the first most used tool of the Fed? And that would be open market operations. So open market operations is the purchase and sale of government securities, which is really just bonds, okay, buying and selling bonds by the Fed in order to increase or decrease banks' excess reserves. So again, it always comes back to this whole idea of reserves, right? And I keep saying excess reserves. I guess I should explain that if you're required to have 10%, right, then 10% is your required reserves. But if in reality you have 12%, then you have excess reserves of 2%, right? So anything above and beyond your required reserves that you're keeping as a bank, those are excess reserves. So open market operations determines something that's called the Fed funds rate. So we've got another interest rate here, right? We just talked about the discount rate, which was how much interest that banks pay the Fed for an overnight loan. Well, now we have another interest rate, which is the Fed funds rate, and that is the interest rate that banks pay each other for those same overnight loans. But instead of borrowing from the Fed, they're borrowing from each other. Now, I'm going to put open market operations on hold for just a second and talk about this idea of Fed funds rate. The situation here is that banks are actually discouraged from borrowing from the Fed. It makes them look weak. Let's just put it that way. So what they would rather do is borrow from each other. So quite literally, Bank of America may borrow enough money from Chase Bank at the end of the day to make sure that they have their required reserves. And when they lend to each other, they charge each other interest, of course, because nobody loans anyone money for free. And the interest that's charged there is called the Fed funds rate. And through open market operations, the Federal Reserve Bank tries to manipulate the Fed funds rate. But here's a key. The Federal Reserve Bank does not have the authority to set the Fed funds rate. It is set by market forces. It is set by banks. The Fed can't tell Bank of America how much to charge Chase for a loan. So the Fed targets a Fed funds rate. So how do they reach that target? Well, they use open market operations to figure that out. And so if we go back through our definition here, the purchase and sale of government securities, buying and selling bonds by the Fed in order to increase or decrease banks' excess reserves. If a bank has a lot of excess reserves, they're going to charge less for a loan because there's lots of excess reserves. It's a supply and demand function. But if banks don't have a lot of excess reserves, borrowing that out is going to be more expensive, and so the interest rate's going to go higher. When the Fed buys bonds, excess reserves in the banking system increase and therefore is expansionary. So what I want you to know is that buying bonds is expansionary, selling bonds is contractionary. Okay? Buy big, sell small. That is the little shorthand thing that you might use to memorize this. And what I mean is getting bigger or smaller is the economy. Aggregate demand shifting right or shifting left. So buy big, sell small, memorize that. We will get way more into the weeds on how open market operations determines the Fed funds rate later. Again, for today, I want you to know that open market operations is buying and selling bonds. And I want you to know that buying bonds is expansionary monetary policy and selling bonds is contractionary. And I want you to know that open market operations is the primary tool of the Fed. This is the thing that they do every day. This is what the Fed does, constantly tweaking the money supply. Finally, there is TAF, this thing that was just invented in 2007. Never seen an AP question about it, but it's old enough now historically that you could see a question about it. And what it stands for is term auction facility. And what it is, another tool. It's extremely expansionary. It's only an expansionary tool. But basically, if the banks, all of them don't have enough money to loan each other money in the Fed funds market, right? We talked about at the end of the day, you have to have your reserve requirement. And if you don't, then probably what you're going to want to do is borrow from another bank, and you'll pay them the Fed funds rate. But what happens if you start calling around and none of the banks have any extra money? Then you would want to borrow from the discount window, right? Using the discount rate. But the Fed wanted to have a tool that was even more streamlined, even more expansionary than simply borrowing through the discount rate. And so they came up with this idea, and the reason they came up with this and needed this was because there was a full-blown financial crisis happening. And so what they did was they set up auctions, and they basically sold the overnight loans. Well, they were not overnight, they were short term. So they were a little bit longer in length than overnight, which gave a little flexibility. And they sold them to the highest bidder in terms of banks. So that's what term auction facility is. Okay, we'll get into a little more on that in the future, but what I want you to understand for now is term auction facility is only expansionary, and it is an actual short-term loan that is auctioned off to banks that are willing to pay the highest interest rate. And it was used exclusively in, beginning in 2007 through 2009-ish. Not sure exactly when this came to an end. It was used exclusively, though, during the financial crisis known as the Great Recession. Okay. Now, let's just cap this off by looking at what's similar about these three Fed tools. They all manipulate the cost of banks to borrow money overnight. And the reason that banks need or want to borrow overnight so much is simply because they must meet their required reserves. So this is all about meeting your required reserves. How are you going to get that money? And how likely are you to need to get money at the end of the day as a bank? All right, so today we introduced monetary policy, and we talked about expansionary versus contractionary monetary policy, which is the difference between adding money to the money supply or taking money away from the money supply. We talked about the ways that the Fed does that, which is by setting the required reserve ratio, either raising it or lowering it, by raising or lowering the discount rate, by doing open market operations, buying or selling bonds, which a side effect of that is to manipulate the Fed funds rate. And finally, we talked about TAF. So those are the Fed tools. You do need to know them. And then next time what we're going to do is put it all together and start to graph it. So until next time, happy studying.